So first of all, thank you everyone for joining. We appreciate everyone taking the time, and obviously especially with what's going on with COVID right now, just networking and kind of talking to others has been a challenge. So we appreciate you taking the time and being on this session. So my name is Michael Mintz. I'm the CEO and founder of MD Squared Property Group. We are a property management firm and investment firm located here in New York. We manage about 3,000 apartments. We have offices now in New York, Connecticut, and Oklahoma, and are continuing to look at other markets, especially given some of what's going on right now with COVID and generally kind of the instability within multiple different markets. So I want to introduce Ron Eliasaf. He serves as the managing partner of the Northwind Group. Ron founded Northwind, a real estate private equity firm, in 2008. Ron is responsible for managing and executing all company activities, including deal originations, acquisitions, development, construction, asset management, loan servicing, property management, leasing, financing, and disposition. So they do a lot of things over there. Since Northwind's inception, Ron has overseen the development, acquisition, and financing of over $2 billion worth of real estate. From 2010 to 2016, under Ron's leadership, Northwind concentrated on the acquisition and development of income-producing assets held by long-term owners, predominantly in Manhattan. During this time, Northwind acquired 1.75 million square feet of real estate in Manhattan, including the acquisition and transformation of 40 Exchange Place, a 300,000 square foot office building in Fidei. Northwind conducted a major capital improvement of 40 Exchange, transforming the building from a Class C to a Class A office building, and successfully exited the deal in 2018, earning a 1.5 times return and a deal IRR of 16%. In 2017, recognizing a peak in the Manhattan market, Ron developed Northwind's lending platform. Through the lending platform, Northwind originates and acquires first and second position debt instruments secured by real estate assets in the form of acquisition, bridge, condo inventory, distress, rescue, NPL, and other special situation financing. To date, Northwind has originated over 20 loans totaling more than $130 million in value. Additionally, in 2016, Northwind developed a strategy of investing in and providing financing for healthcare and senior living opportunities along the East Coast and the Midwest. In 2016, recognizing a void in the market for upscale senior living options in Manhattan, Northwind acquired 305 West End Avenue. Through a major capital improvement plan, Northwind transformed 305 West End Avenue into the first high-end, fully renovated, licensed assisted living residence in Manhattan. Furthermore, in September of 2018, Northwind acquired an 8-property portfolio that is operated by CareSpring Healthcare Management and entered into a joint venture agreement with CareSpring for future growth opportunities, including acquisition and development of new senior living and skilled nursing properties. Northwind current senior living and healthcare portfolio includes 14 properties in New York, New Jersey, Ohio, and Kentucky, totaling to just over 1,500 skilled nursing beds, 413 assisted living beds, and 324 independent living beds, and is valued at $500 million. Prior to founding Northwind, Ron co-founded and served as CEO of EXRE, the real estate investment platform of one of Israel's largest family offices, which has invested in a portfolio of 32 grocery-anchored shopping centers located in Florida and Texas. Ron is a retired captain in the Israeli Navy and sits on the board of American Friends of Natal, a nonprofit providing vital assistance to people suffering from PTSD. I will also say that Natal, actually, I recently, through Ron and Rachel Korn, who works in his office, got involved with Natal. It really is an amazing organization, and maybe later on we could have a little bit of an opportunity to talk a little bit more about what they do. Ron received an LLB in international law and BA majoring in finance from IDC. So thank you, Ron, for being here.
Thank you. Sorry for that long intro. You know, you don't realize what you do until you hear somebody else say it. So I guess
it's a lot that you've accomplished. And I'll say I actually feel especially lucky. I know I had met you pretty early on, actually, through YJP, and been able to kind of follow your career as you both founded Northwind and have kind of excelled in your career. So seeing a lot of these things happen has been pretty amazing, and it's extremely impressive.
Thank you, Michael. And first of all, it's good seeing everybody, and I hope really everybody is safe and healthy. It's really strange times we're all in, and it's great seeing everybody this is the new face-to-face, right? The virtual face-to-face. So hi to everybody from home or from office, and it's good seeing everybody.
So Ron, can you tell us a little bit about your founding of Northwind and what made you decide to start your own fund? Obviously, you know, a lot of people on this call are younger and are kind of looking to develop their careers further. So I think it would just be interesting to discuss how you went about founding Northwind.
Sure. It all happened, you know, almost by mistake, I would say. I mean, I served, as you said, I was a captain in the Israeli Navy for 6 years. When I finished my Navy career, my military career, I actually went for, as many Israelis do, I went on a 1-year trip. I was a surfing instructor in the Dominican Republic. I opened up a surfing school, and actually I'm still thinking why I ever made it, why I returned from there. No, seriously, I went into law school, and since I started things a little bit late, I mean, I went into law school, I was already 25, which is late compared to the US. It's not that late for Israel. But it was very clear to me that I didn't want to finish my degree within 4 years and have zero real experience. So what I decided in my first month into law school, I said, okay, I want to find a job and I want to work as a personal assistant for somebody who knows business, and maybe I can learn a thing or two from him while I'm in law school. And I was lucky enough to find an attorney in Israel that really helped and worked for a lot of South African nationals that invested in Israel. And I started out initially, the first few months, I was as driver / secretary, basically did whatever he asked me to do. And then as he slowly trusted me, he gave me more and more responsibilities, and we ended up buying a lot of real estate in Israel. I'm talking about 2006, 2007, those years. And he was a very smart person. He was not only an attorney, he was also a CPA, and he was really a trusted advisor for a few very, what you call now, ultra high net worth individuals. I didn't know that phrase back then. Now we know it. Unfortunately, this is where the story takes a sad turn. He passed away from a very aggressive bacteria in his lungs in April 2007. And during the Shiva, you know, I was the young guy in the office. People came from South Africa, and during the Shiva, they started asking me, you know, Chaim, his name was Chaim Rabinovich, by the way, may rest in peace. And, you know, the stories were like, you know, we have a portfolio of properties in Jerusalem. Chaim was our trusted advisor. We don't really know what's going on with it. Maybe you can help us. And then somebody, you know, had a trust account that he held, and I slowly started helping his clients, you know, unwind, sell, you know, continue to manage some of the properties, and that was really my start. It was really, I was just propelled probably 10 years ahead because of all those occurrences, and I had to deal with a lot of stuff that were way above my pay grade at the time, but I ended up gaining the trust of a lot of people, and I did right by them. It was a lot of complicated situations. Most of the properties were held through BVI entities, you know, bearer share companies, a lot of stuff that were, you know, complicated tax structures. So I was, unfortunately, you know, the right person at the right time. But I think the decision of starting to work and being a right hand or being a personal assistant for somebody while I was studying, that was probably the biggest, best decision I made at the time when I really started my career.
And so can you tell me a little bit more specifically about the founding of Northwind? What were your first deals? Obviously, through that experience, right, it gave you opportunities to meet people, it gave you opportunities to run certain deals. But in terms of deciding you were going to start your own firm instead of kind of doing this in some broader kind of...
So the interim period, you know, after Chaim passed away, very early on, a family office in Israel invited me to join them and help them manage their real estate activities. And that's when I founded Northwind. At the time, it was my personal company just to hold my stake in the fund we ended up forming in 2008. The name Northwind, by the way, is because I like surfing and windsurfing and kite surfing. And in Israel, the best wind to surf, the windsurf, is the wind that comes from the north. So that's the name. I never thought we'll use the name with outside people, outside investors. It was just my personal holding company. So initially, I formed it. I was the only shareholder. Later, I got married, so now we're two shareholders. And we we formed a fund that focused originally in buying grocery anchor shopping centers. That was in 2008, 2009, 2010. And we really, in the early years, we bought mostly notes and distressed debt backed by those properties. We had a very good run between 2008 and 2010. I mean, I was flying back, I was still based in Israel, and we were flying back and forth to the US. And it was a strange time because we were liquid, but many people were not liquid. Many companies were not. A lot of people were dealing with their own legacy portfolios. And every deal we did at that time, I'm talking about 2008, 2009, I mean, our hands were shaking. We felt like we're the only idiots buying. We bought, grocery anchored shopping centers in Florida. The anchors were Publix groceries. Maybe there was the Walgreens, but all the other smaller tenants were all closed up or out of business. So you're buying a property that's 65% occupied, and the question, we did not know how we're going to lease it up. And that was a good 3 years. And then really the next step was when I decided to exit that business, and I kind of stopped believing long-term in retail, probably too soon. I mean, this was 2011, maybe a little bit too soon. In hindsight, it was the right decision, but we definitely lost some cap compression. And then I always had a passion to Manhattan and to do real estate in Manhattan. My father did some real estate in the city in the 90s. And I started doing deals in New York, initially with a local partner, very fast, just deciding where we want to be the owner or operator. And that's really when Northwind became a real company and not just my personal holding company. I had a little bit of money, not a lot. I realized I will not be able to do deals in New York with my capital. So I invited two of my biggest LPs, my private investors, to join me and infuse more significant capital into the company. And that was in 2012, where my two partners, Roma and Jacob, joined me. There's some background noise. I don't know if,
I think we're good now.
Okay, good. So in 2012, that was the next evolution for Northwind, where I had GP partners, general partners, coming in, infusing significant capital, and then really enabled me to tackle bigger deals. In New York, when you sign a contract, it's usually you sign a deposit. It's non-refundable. There are no contingencies, no financing contingencies, no due diligence contingencies for the most part. So for me, the time to put $1 million as a deposit, and still now it's a lot of money. And I realized that I will not be able to do a $50 million deal with my capital. Usually a $50 million deal requires you to put, $3 to $5 million deposits, which is real money for anybody. So that was the next evolution, having serious GP partners joining me, allowing us to write bigger checks. And that's when we started doing, deals like 66 Pearl Street, which was a $30 million acquisition. Until that time, most of my deals were...
Raquel, I think...
Attends, c'est quoi? Je vais prendre mes AirPods. Une seconde.
Perfect.
My initial deals were, $3 to $10 million deals. Then in 2012, 13, 14, we started to do deals between 30 to 50, and then from 50 to 100. For the exchange that you mentioned, we did in 2015. That was my first, $140 million transaction. And it's not about the dollar size, really. It's about, the ability to take a significant building in such a competitive market as New York. And really, Northwind slowly became a more, solid, prominent player. And it took us a lot of time. I mean, the first 5 years were very, very difficult. Initially was difficult to get financing and difficult to get equity. And it's like the flywheel theory, if you read the book. It's like, it's hard, but then every deal you do, it slowly becomes easier and easier and easier. And what I've learned, and really that's maybe one of my biggest lessons, if you have a good deal lined up, the capital is there. Capital is just there, if it's the equity or the debt. And my best advice to young people in the business, don't worry about getting the capital, worry about getting a good deal. If you got a good deal, there's tons of capital that will come to you, and you'll be able to get maybe not the best of terms, but good enough terms, especially if it's your first or second deal. And the size is not an issue. Don't be afraid of going after a larger deal, because sometimes they're actually easier in getting the capital lined up.
So speaking specifically, I know you said getting debt for you initially was difficult, and now you guys have transitioned also into doing some lending. Um, Within the past few years, you've both gotten into lending and healthcare spaces. Can you tell me a little bit about kind of what piqued your interest in those spaces, what kind of deals you're seeing and looking to do in those spaces? And I guess if you were to start over again, would you have considered doing some of those types of opportunities from the start, or did you feel that kind of starting with the types of assets that you started with was a good progression for you?
It's all about personal evolution. I mean, when I started, I really started my career back off, one of the biggest, financial crises. So the timing was perfect. And, hindsight, the deals we did made us look, smarter than we really were. And that was a lot of luck and just being at the right time, at the right place, and being able to do deals. Initially, I wanted to build. I had this dream of being a real estate developer. I wanted to build buildings in Manhattan, and I had that passion in me. And it actually caused me to do a few mistakes. For example, there was a deal we bought in 2012, a land. We built a building on it. We had plans to build a building. We got offers to sell that land for double the price a year after. We said, no, why are we going to sell? It's not the right way we want to build. And had measuring deals not just by their outcome, but by how their outcome is weighted against the actual risk we took. I started deviating from my passion into development, and I realized that for me, the risk involved in developing a building in New York City doesn't justify the return for the most part, on average. I mean, you'll have that single development deal that you'll knock out of the park, and you'll make 3x, 4x, or whatever. But if you do it consistently, you'll see that it's just, on average, the IRRs are on average maybe 15 to 18%. And when I realized that's the yield on, we do one deal, it's one thing, but when you do 10 deals, you start looking at things at a certain scale. And it just stopped making sense, especially as we saw that land prices went up. So that's why we made our first evolution into income producing, where we felt, why take development risk? Let's buy income producing properties. We'll make 12% IRR, 13% IRR, but we won't have to take that risk of, I call it the 2-year option. When you develop a property, you're immediately in a 2-year option on the market. Because your starting point is now. You'll finish the project if you're good in 2 years. You don't really know where the market will be in 2 years. So that option is very, very expensive. So we initially decided, let's take a 3% reduction in our target IRRs, but let's not live in the future, let's live in the now and do income producing. And then what happened in 2016, also income producing properties stopped making sense. And what I came to realize is that value is very hard to determine. And when we realized I can't determine the value, I said, I need a margin of safety. And how can I get that margin of safety? Let's lend and be the lender and have the equity of the borrower as our cushion if we're wrong about the value. And we saw it happening. That risk actually materialized. We were looking at income producing properties like multifamilies. Michael, you know that asset class very well. Who could have underwrote the change in legislation, right? That yep. Completely changed the value matrix right now. It's still an open debate. What's the new values? What are the new cap rates? But it's definitely different. I mean, 4% was the norm for a multifamily building in New York. I don't think that's the norm anymore. Definitely not for the buyers right now, right?
Right.
So because we saw that and we recognized, we didn't recognize the shift in legislation, but we did recognize the peak in the market. And when you see deals happening at 2.5 cap rate, something is wrong. And we sold some properties. We sold our property at 66 Pro. We sold the retail. We had 7 retail stores. We sold them at a 3.4 cap rate. And when we did that exit, we said, every time you're either a buyer or a seller, I'm definitely not buying it at 3.5 cap rate, so I'm definitely a seller. And the point I'm trying to make is that we've evolved into lending because equity stopped making sense for us. Now, just for us, it's for our appetite and for our risk. We're slightly different than other shops. what Northwind has really evolved into. We're the real estate asset allocation arm for the family office of each of the partners. So we have a more long-term view, and we think more in capital preservation. We're not, three young guys trying to make a promote and a fee. We're really trying to put our capital where it makes sense, and that's why we constantly ask ourselves, does it make sense? Does the risk justify the reward? And that's why every 3 or 4 years we had to evolve. And it's tougher to evolve. It's much easier sticking into one asset class than what we did, because we did development, we did multifamily, we did office, then we did senior living, then we did loans. So we became very prolific, and it's not because we were all over the place. It's because every time a certain market just stopped making sense, so we had to evolve to the next one. And lending for us is the next evolution, and right now in New York, it's making a lot of sense for us.
So Ron, can I ask you, from your perspective, when is the right time to jump back into this New York market? Obviously, right now with COVID, there's a lot of kind of other factors involved, but generally, what indicators are you looking for to say, okay, I'm ready to jump back into this market as a multifamily equity owner?
Okay, I'll tell you, it's always the time for the right deal. I mean, there are bad deals in a good market, and there are great deals in a bad market, and there are, so it's all about understanding the asset class and what you're doing. I mean, we have our current portfolio, and for the most part, we're very happy with what we have. We're constantly looking at deals. Right now, we're focused on debt deals because what I've said about we wanting that margin of safety. But if somebody brings me an office building or a multifamily and I can buy it at a 6.5 cap and it's a real 6.5, I'll buy tomorrow. Because you have to decide what your investment mantra is. And for me in New York, I'm bullish on New York long term, very bullish on New York long term, because it's still the financial center of the world, the academic center of the world, definitely the political center. We became a serious tech hub. So there's a lot of things that are going for New York. But I'm bearish in the short term because even before COVID, I mean, the market was not in a healthy place even before. I mean, there was oversupply in many asset classes. We kind of finished a 7-year construction boom almost across the board. You had diminishing demand in resi, in condos. You had diminishing demand in retail. I mean, retail was already at 20% vacancy in certain, in Soho and other prime corridors of retail before COVID. Hotels had reduced occupancy and ADR even before COVID. Everyone with a condo project for sale saw that it takes longer to sell units even before. Then we had that legislation shift and taxation shift. So the market was in a tough place before, and now COVID came in, and it will just expose the weaker links. I mean, it's not that we're not going to have defaults across the board, but you're going to have defaults in those projects that are over levered or that have had a too aggressive business plan, or actually just are not able to come up with that additional equity they're going to need to in a few months to carry themselves over. So there's going to be pockets of pain, which will create pockets of opportunity.
Now, on the debt side, in terms of your kind of lending requirements, interested in understanding kind of the loans that you guys are doing. What types of, for example, loans to values are you giving out? Are you covering any construction costs or anything like that? And then now, especially with COVID, I know that the bridge and mezz markets have been really kind of basically non-existent for the past couple of weeks. Are you seeing any movement there? Is that stuff that you guys have any interest in, or kind of what type of loans are you guys looking at?
Right. First, I'll say that the market is frozen, but that's really short term. I mean, right now we're in kind of a pause. It's a general pause. Landlords can evict tenants, the lenders can do foreclosures or won't do. So it's very typical for a market to be frozen up. It happened, the same thing we saw it in 2008. The question is, what will happen 2 months from now? When restrictions will get eased off, and for the most part, it's probably going to start tapering down in May, more significantly in June. Probably by July, most restrictions will be off. And then the real question is, what's the new reality? And I think that's what lenders are looking for. That's why people are halting right now, because they want to say, what's the new reality? I mean, we saw multifamily rents. I think the last statistic I saw, 85% of the tenants paid. roughly. I don't know what you see in your portfolio.
Yeah, no. So I've seen statistics like that too. I know for most people that I've been speaking to in New York, though, I'm actually seeing on the multifamily side higher numbers than that. So I know we're right now at about a 95% collection rate. I know that other people I've been speaking to are not that far off. It's the retail that seems to really be.
So at retail, that was my next sentence. Retail, although it's 15% paid and 85% not paid.
Right.
So that's, but April is given. The question is what will be May and June, because that's going to be the new reality. People can still carry over a month. Most people can still carry over a month. Most people, definitely blue collar, tough to carry over 2-3 months without pay. So I think that's going to be the question. That's the question that most lenders are asking. We're more value-based, so we would lend today on any property that makes sense. I mean, most of our loans right now are geared to acquisition bridge, condo inventory, and I think that's going to probably evolve into some what we call rescue loans. By rescue loan, meaning the lender is pushing hard on the borrower, and the borrower is just looking for somebody to replace them, and will probably take a higher rate, but a more flexible term, covenants, duration, stuff like that. We are not seeing it all distressed yet. There are no distressed loans. Banks are not selling loans for the most part at discounts. That's not happening yet. It might happen. That's why we're raising a fund right now, because we think it could happen, but it's going to take some time. It usually lags 4 or 5 months from where a real crisis occurs to when things really start to shake up. The main difference between 2008 and now, there's still tons of liquidity out there. The banks are liquid, the banks are solvent. A lot of debt funds have a lot of capital, a lot of equity funds for the most part. We had a 3-year run of a lot of funds and private equity just raising a lot of capital, which is discretionary. So a true crisis will never happen when a lot of people like us are sitting and saying, okay, let's wait for the opportunities. Then the opportunities don't come, right? Because there's too much capital. So it's going to be very interesting to see. Where it's really going to hurt is probably hospitality. Hospitality is going to go through a very big downturn right now, because I don't think occupancy will go back to 90% in July, right? And I think you'll see some lenders putting X's on certain asset classes. I wouldn't be surprised if lenders will give a general X on retail, on hospitality, on condo development. Those asset classes would find it tougher. Multifamily, because it's such a need-driven business, you'll probably have more capital going to it. And like any crisis, you'll see a flight to quality. The better operators, the better assets will have access to better capital. You know what? It might be even cheaper capital because rates just went down 2%. So you might see like across, you'll see the A-class properties and operators getting better capital than what they did a year ago, maybe cheaper even. And then the B-class, worst locations, worst operators will have maybe zero liquidity or zero availability of capital. So it's going to be very interesting to see.
And do you see the timeline on kind of some of these lending markets kind of opening up being sometime in May or June, once people see kind of where collections are for those months and have kind of a better sense of the stability of the market? Or when do you see that really occurring?
The real answer is I don't know, but I think the time frame you're saying is probably right. I think April and May are going to be frozen a little bit, and then you start loosening up. I mean, eventually it's very hard for lenders and capital providers to sit and not provide capital. I mean, it's very hard. That's their entire essence. That's how they get their people paid. And so I think you're going to see it probably opening up in June, but then it's going to be a very binary. Certain asset classes go, let's do it. For certain asset class, we're not ready yet. I'm hearing a lot of warehouse lines and repo lines are putting, limitations on retail, on hospitality, on senior living, stuff like that. So it's interesting to see which asset classes will be, prominent. Also, a lot of people are waiting to see, what's going to happen with the office market, and will the office market see a readjustment? I mean, it's a big component of the city. What's going to be worse, though, and this is maybe the next crisis that's going to come up, is, and not a lot of people are looking at it, is the municipal bonds. I think municipal bonds, or I would say the stability of municipalities is going to get undermined, because we're in the real estate business. The real estate business really supports the payroll of New York City with property tax. But if rents are declining, property taxes will also decline. And I think what we're going to see in certain parts of the United States, it might happen in New York, but other cities, you might see municipalities having issues with their bonds. And they'll default on their bond covenants because they'll get paid less for property tax. And that's what a lot of legislators and politicians don't understand. I mean, the real estate industry has been really the battering, like everybody was hitting on it for the last 3 years as like we're the big pocket, let's take more money from the landlords. And it's going to come back as a boomerang to the city.
Okay, so really quickly, just want to remind everyone this is supposed to be interactive. So obviously feel free to ask questions. You can either put them through the chat, raise your hand virtually. We will have a time at the end where we'll kind of leave it more free for people to ask questions. But even right now, you're welcome to ask questions by raising your hand or putting messages in the chat. So Rand, when you were talking about some of the frozen markets and kind of some of the asset classes that lenders might just be putting X's on, you specifically mentioned healthcare. I know you guys have exposure to that space right now, so I'm sure it's something that's on your mind pretty heavily. What are your thoughts on that? Obviously sitting on both sides of the table, both as a owner of healthcare facilities and then also as a lender. I'm interested in your outlook specifically on the healthcare space. Yeah,
healthcare is very interesting right now, and it comes back to what I said. I mean, the headlines are very scary. You read the headlines of, in the New Jersey property with 70 people dead, the Queens property with 20, it's very scary. When you dig deeper, you see that's really happening for the most part for operators that had issues even before COVID and have very low star ratings. And as I said, quality operators, if you look at their portfolios, it's not going out of whack. I mean, in our portfolio, as example, we had one case in New York, that's it. And New York is the epicenter of the epidemic. We had 3 cases in New Jersey, and we had 0 in our portfolio in Ohio. And why is that? It's because we started very early on doing, we closed down visits, no visitations, which is a sad thing to do, but it's the right thing to do. We changed to serving meals in the rooms, which costs more for us. I mean, you need more staffing to do it, but that's the best way to keep, the residents safe. We stocked up on all the protective gear for our staff very early on. Everybody had to use masks. I think maybe because my linkage to Israel and Israel got hit a little bit earlier, we kind of a little bit saw it coming, maybe a little bit more, but also other operators. So you see, when you look across the industry, you see, yes, some properties got hit very badly, but it's probably because they didn't do as good of a job as using the protective gear and separation and keeping the procedures. And it's still very sad and unfortunate. Regarding to, yeah.
I just what we keep on coming back to, that you're involved both with real estate and healthcare, and what drew me personally to this FaceTime was because what I saw. I also actually started law school when I was 25, and I was fortunate to work for the family that bought 66 Pearl from Northwind.
Nice.
And so that was like the business experience, and that got me more involved with real estate. And then also I saw that in my communities, there's real estate and there's healthcare. In Orthodox communities, those are the 2 industries that people get into. So my question is, why do you think, if you can say, why does the Orthodox community, what draws them to those 2 industries, just based on your experience? And also, what are the risks in each one? I guess the pluses and minuses in each one.
Okay, it's a broad question. I'll try to answer it.
Sorry, just to also chime in after this, Ron, there were a couple questions asked in the chat. So what I'm going to do is, I think Michael and Corey, you both asked some questions in the chat. If you guys just want to unmute yourself after this and just ask your questions, just because to try to control it a little bit, I think you guys just all ask your questions and unmute yourselves.
Sure. So I'll answer this, and now I actually see the chat, so we can respond to the chat questions. So I will first say that healthcare is not real estate. Even though it's a business that resides in a real estate property, and we do not view it as a real estate allocation. It's not part of our asset allocations for real estate. We view it as a separate arm, a separate business with different risk rewards. we sometimes try to bifurcate the risk by, what we're doing a triple net lease. So we buy the property and then we do a long-term lease to an operator. But unlike a true triple net lease in real estate, where you need to net lease it to a Walgreens, which is a real estate transaction, in healthcare, it's not really, because you share the risk with your operator. So let's say the operator is making a certain spread above your triple net lease. But then at a certain point in time in the future, operations are not doing so well, and it's not because the operator is not a bad guy or is, it's just because the reality of the market. You will get the call from the operator saying, listen, I cannot pay the rent. I need to reduce the rent. And you're not going to be able to replace that. If he's a good operator and he's not a liar, you won't be able to replace it with somebody else, like in a hotel business, and say, you know what, I don't think you're doing a good job. Let's bring somebody else and I can keep my rent. You're really going to have to reduce your rent. So you're really sharing the downside with your operator and giving him a lot of the upside. So that's one of the biggest differences between healthcare and real estate. Where in real estate, it's really the risk of your tenant. And if you have a good lease with good covenants and good security deposit, you're not sharing the downside with him. You're not supposed to. That matrix is actually changing now. If you see WeWork and you see, or the other co-working spaces where there was a lease structure, but now they're saying, well, I can't pay it, let's reduce the rent, and a lot of the landlords might actually have to play that game with them. Why did the Orthodox community go to healthcare and real estate?
I'm sorry, when you said, I thought healthcare was actually operating, but you're saying you do more you buy the property and then do almost like a triple net lease to an operator.
Yes, we do. We are actually in the process of buying an operator company, because we came to a size where we realized we actually want to have operating capabilities. That deal is something that we worked on. Now, then COVID happened, so now it's a little bit in waiting mode, but hopefully it will get back. And we're doing it because we came to the realization if we're sharing the downside, we might as well enjoy the upside. So let's buy the operator and also have that upside, because we're taking the risk. I think in the Orthodox community, it's a lot because it's a close community and people tend to go into businesses that they're familiar with, and it just so happened the Jewish community is very heavy into real estate and into healthcare. I think it's a business that is, on the one hand, approachable, accessible, and for, I would say, it's not simple or easy, but yeah, since there is a critical mass already of Jewish people in both businesses, that's why probably people are drawn to them, right?
Okay.
Michael, you want to do the chat?
So this is from Michael Mustaf. Michael, I don't know if you want me to ask it or you'd like to ask it.
I'm happy to ask it, sure.
Yeah, go for it.
Okay. Ron, you mentioned earlier that you're raising a new fund. Could you elaborate on the purpose of the fund? Is this acquisitions focused or lending focused? And I'm also involved in lending. I'm just curious. You said that a lot of lenders are on pause, and that while you're willing to look at any deal, if it makes sense right now, are you essentially on pause for the next few months and waiting to see which way the wind blows as well? What are your thoughts in general?
First of all, Michael, it's good seeing you, and I missed you. I think we met last time too long ago. So it's great we have this chat to reconnect.
Likewise, thank you.
It is a debt fund. It's going to be about $200 million in committed capital, which will allow us to do probably around $400 million of lending across, around 4 years of investment period we're going to have. So it's a debt focused. It's a New York focused debt fund. 80% of the fund is going to be in first position, senior secured, and 20% will be in mezzanine positions. We're not on pause. We're looking at deals every day. Rachel and Robert from my team was on this call. Every day we're screening deals. A lot of them are not meeting our criteria, and our criteria are value-based. We look at a good basis per square foot, obviously a good sponsor, and most of the deals we're looking at right now are either acquisition bridge or condo inventory. And we're very active in condo inventory, and our capital is readily available to do a lot of condo inventory and bridge acquisition. And then it might transition into buying notes, but maybe some rescue capital in distress. But again, we're not seeing it right now.
A lot of the condo inventory loans that have been bouncing around the last few months have been based on inflated valuations. Do you anticipate that will change radically over the next few months and perhaps become more attractive for you?
I don't know if there's going to be a radical change. I mean, that's the big question. I mean, for the most part, prices already went down about 20% in the last 2 years. If you really look at the numbers. I don't know if, maybe some developers that are stressed will start slashing prices. We haven't seen it really. There's really a lot of waiting game right now. People are waiting and caring, and I think a lot of lenders are going to be flexible with the bars, and they'll give them another 1-year extension, and we'll figure it out somehow, especially if it's a finished project that had a few sales. The projects that are in mid-construction or are really delayed in construction, and that's also one of the issues that happened in New York in the last 2 years. It became so much more difficult to build, so many more delays because of how the DoD is working and stop work orders, so a lot of projects are delayed. Those are going to be tougher. If it's not a finished building, I think it's going to be tougher to refinance or to get extension from the lenders. It's going to be interesting.
Thank you.
I hope it answered your question.
Absolutely. Thanks very much.
So just want to mention, David Brodolowski, I saw your hand being raised, so I'm going to get to you. I'm just going to kind of go in order of where they came through. So I think it's Corey Kessler. You had asked one, if you want to ask it.
Yeah, sure. Thank you guys for your time. Appreciate it with everything that's going on. Just wanted to, there's been a lot of talk about 2008, the crisis versus the COVID-19. Obviously, two different situations, but people have been talking a lot about similarities and differences. What do you see as the similarities or the differences between the two, 08 versus what's going on now?
Yeah, it's a great question. I think the biggest difference, again, I'm not a macroeconomic, I'm not Nouriel Roubini, but I think the biggest difference is 2008 started in the financial industry, and it really hit liquidity. This crisis is really starting in Main Street, in the real economy. I mean, shuttering businesses, small, medium businesses, restaurants are closed, hotels are closed, events, theaters, all the stuff we're used to as part of our life are closed. So the crisis is starting at a very different point. Actually, the financial industry is in a very good position, relatively speaking, relatively liquid, with all the changes that happened after, the regulation and Basel I and Basel II and the capital requirements. So the financial industry seems to be in a very good position, but the real economy is suffering. And when I look at the U.S., I mean, 70% of the U.S. GDP is personal consumption, private consumption. And when so many people are out of a job or being furloughed and don't have spare income, that's going to hit consumption. And when consumption is hit, it could be a much more severe crisis than 2008. I mean, if you look at New York, if you guys remember, 2008 you had like 6 months of a tough time, and then it really started exiting very, very fast. The duration of time in New York was distressed, was relatively short. I think this time around it's going to be different. I mean, I don't know how many restaurants will reopen in July. I mean, if I'm a restaurant owner, opening a restaurant in the regular time, you're going to be in a negative cash flow. You just know it. Even if it's all regular, you have at least a few months of negative. This time, if they're going to limit the amount of patrons coming in for a while, why open the restaurant and bleed cash? So those businesses will stay closed for a while, and that means a lot of workers are going to stay unemployment. I mean, I don't think unemployment will stay at 20% where it is projected right now. It's probably going to taper down, but to where? 10 to 12%? That's still insane. That's still a lot of people out of the job. Still a lot of people unable to put dollars into the system. So I think there's a potential of a much more severe crisis. The only difference is that if in 2008 it was relatively a novel idea to print so much money, we now live in that it's the standard. And we're living in the biggest economical experiment in human history. I mean, never before so much money is continuously being printed and printed and printed. So aside from the very improbable case of the US printing too much money and going into a phase where it's unable or it devalues the dollar so much and other countries no longer trust and no longer buy the US treasuries, and then you'll see the rate on the treasuries going up. which means the US will be in default. Other than that unlikely scenario, they're just gonna print so much money to try and solve it. And it's scary and hopeful at the same time.
Thank you very much.
So Elliot, I think, had our next question.
Yes. Hi. I'm in the office leasing market, and what we're seeing is that first, people have to feel comfortable going back to work. And to do that, there's a lot of talk about different physical changes to the workspace, less densification, more private offices, really focus on greenery, health, wellness, to get people back to work. Now that will cost more. Construction costs and operation costs will go up. So I think naturally some landlords are going to try to push rents a little bit. But on the other hand, a lot of companies won't be able to reopen. We work, tell our tenants in our portfolio, and to some extent they're talking about giving back space. So I think there's certainly going to be a lot more space coming on the market. We've seen the rents the last 2 or 3 years really go up incrementally. Where do you see rents in Class B buildings in the next 6 to 12 months from now, given everything that's happening?
Good question. It's funny. We also saw that in our portfolio. I mean, it used to be the standard for 250 square foot per employee in office space,
Yep.
And that number really condensed in the last 5 years to like 150 because companies start utilizing more open space where they condense. So I think there are two themes that are clashing right now. There's the one theme that says, companies will realize this Zoom thing works and they'll need less space and they'll need less footprint. So there's going to be a negative pressure on rents. And there's another philosophy that you kind of mentioned. Actually, in order to make office space work, you're going to need to be less dense right now. So you actually need eventually, the cubicle system requires more space than the open space system, right? I don't have an answer for you. I think it's too soon to tell because of how lease duration works in office. 3 to 5 years on average, at least on the smaller spaces, longer. So you might have that talks, especially those talks are starting from the WeWork types, because right now they're immediately pressing on rent reductions and trying to change from a lease to a management and stuff like that. But I think that's not gonna. It's too soon to tell. What will most likely happen is somewhere in the middle. I mean, for me, I don't think you can build a successful team remotely. I don't think you can build, you create that special sauce, that special unit, that special kind of mix, being each one in their home. And I think it's a great thing. I mean, everybody's enjoying more time at home with the kids for a month and a half, but to do it 5 years, I personally believe office is here to stay, and it would actually be a less dense office, which means actually more space to make it healthy. I mean, what everybody's thinking right now, okay, COVID happened. Lucky for most people, not all, it's not as a severe virus as it could be. I mean, it's horrible and there's a lot of death and it's very sad. It could have been much worse if the virus was more aggressive. And I think in the long run, when people will actually start doing risk management, they'll say, I need to prepare my office space for the next one that will come 10 years from now. And I actually think you're going to see back to the more cubicle concept and private offices and because that's more sustainable in the long run. So that's my opinion, but I might be wrong, and it wouldn't be the first time that I'm wrong.
Thank you.
Hi, Ron. This is David. I'm actually spending some time now in Ohio, visiting my parents just until this thing all blows over. So like you said, a good time to spend with family. My question is a two-part question. One is, what opportunities do you see in the Midwest, specifically Ohio, you mentioned is part of your portfolio that's different, let's say, than New York? And then two, situation as follows. You have like a Class C multifamily property that's now for sale. You mentioned that collecting rents there is going to be much tougher, which makes sense because unfortunately, those are the type of renters that are the first to lose their jobs and have trouble paying rent. But do you see that also from a buyer's perspective as an opportunity? And if so, how would you approach it?
Yeah. Where in Ohio are you, by the way?
Cincinnati.
Nice. So, all of our portfolios in Cincinnati, by the way, our healthcare portfolio. And so in Ohio, for your first question, outside New York, we're only looking at healthcare and senior living properties. So assisted living, skilled nursing, and memory care. And Ohio is a great state for it. It's a CON state, certificate of need, meaning there's a cap on supply. If you and I want to go and build a skilled nursing building right now, we can't. There's a moratorium on getting a new license. That's one of the reasons we like Ohio for it. I think Ohio is a great state for real estate in general. There's a lot of good things going for it. Stable work, relatively good education system, and a lot of stickiness in the population. I mean, people tend to stay for the most part. Strong community sense. It's a great state. We don't look right now at multifamily outside New York. We might change that approach again if cap rates and values make sense. I mean, for us to buy a multifamily outside New York at a 5.5 or 6 cap doesn't justify the risk and the management attention we'll have to bring it. But I can definitely tell you if we'll see if C class is less interesting, it's because of what you said. We think it's too risky, and there's also a lot of capex to go into it. But if we could find a good B class property, a multifamily property at, call it 7.5, 8 cap, we'll definitely buy it all day, right? Those unfortunately do not exist. I mean, they exist on the broker OMs, but then when you really dive deep and you make your real numbers, you see it's not a 8 cap. It's more like a 6.5. And for 6.5, there's good enough opportunities in New York to do. So, and I'll always choose an asset in New York over an asset in Ohio.
Can we go for seconds?
Yeah, Laser, if you want, you could ask your second question.
Okay, thank you. You had mentioned that at a certain point you were bringing on general partners, bringing on GPs. So the company that I work for currently, we're very strictly, we do not bring on long-term investors. It's usually like a 3-year investment, and then we'll refinance and cash out the investors with like a very nice, like a 32% return after 3 years. But did you start off, with bringing on short-term investors or loans, and then pivot to long-term investors? And when did you make that switch, if that was the case?
So I also started with private investors that participated. We did what we call, a syndication into a deal-by-deal structure. We never did loans. I never felt comfortable with taking, all the upside and just giving them a minute. So we always did a classic pref promote structure where investors got a preferred return, and then we got a upside back-ended success, when we either sold or refinanced. So, classic 20 over an 8, like 20% promote over an 8, or 30 over 7, really depending. We kind of modified it every deal depending on its risks. So we did a straight equity syndication, not a loan structure.
Okay. Thank you very much.
So, if it's okay, I'll just
one more sentence for that. Is the main reason is because what our structure creates is, what we call we laugh together, we cry together kind of model. That, if the deal makes money, everybody makes money. If the deal loses, everybody loses. But there's no asymmetrical allocation of the risk between the capital and the operator. We're all in the same boat, and we always put our capital in a significant amount. We were always, and still are, always the largest investor in each of our deals.
We just hope to laugh together on different deals. Thank you again.
So we only have a couple minutes left, and I know that, Ron, for you, Natal, which we mentioned a little earlier, is an organization that you're heavily involved with from a nonprofit perspective, and especially with this being YJP, a Jewish organization, incorporating kind of giving back to the community within our personal lives and our business, I think is something really important. And I know it's something that I admire with you, especially your passion with Natal. I know they've recently started the New York Young Leadership Board that Rachel is running. But so I'd love to hear from you a little bit about kind of your nonprofit work, and if you want to talk a little bit specifically about Natal, and how you got involved with it and why you're so passionate about it.
Yeah, thank you, Michael. So first of all, for those of you who don't know, Natal is really the center that treats trauma patients in Israel and now also in the US. Trauma that's caused from acts of war and violence. It's a non-political across all sectors in Israel. Unfortunately, Israel has a lot of trauma-related or post-trauma-related I would say victims, although it's not, we call it, it's the invisible wound. It's not a wound that you can see, but, it's from ex-soldiers in the IDF to civilians unfortunately, with all acts of terror and war in Israel, especially in the last years, where it's mostly all the rocket attacks in the south of Israel. So the sad statistic is that 70% of the children in the south of Israel are suffering from what we call PTSD, post-traumatic stress disorder, that's caused from all these continuing acts of violence and war. So what Natal does a lot of stuff, but it has, a hotline, and professional workers and social workers and a mobile unit, and every time they get constant calls every day, but usually there's a surge after, certain events happen, because then when the trauma gets, activized. And what they do is they help people deal with that trauma through long-term sessions that are with clinicians, with psychiatrists, with, social workers, and just help children, adults, wife of victims, just deal with their trauma. And what's happening now, in the last 2 years, Natal, we kind of exported the technology that was built and it was active in the US. It started after the Parker school shooting in Florida, and Natal provided, assistance to the staff and children there after the gun rampage event there. And it's working with first responders in New Jersey and New York, firefighters and policemen and NYPD. They deal with they have, PTSD from, their line of work. And what Natal is doing now actually is with healthcare workers in New York, in New Jersey, is they're doing online sessions, they're doing one-on-one and group sessions, and just helping people deal with all they're seeing out there right now. So the frontline people right now are all our healthcare providers. So Natal is a great organization that's been around for over 20 years. I was lucky to meet the chairman and founder, Ms. Judith Percanati. She's a great person. She's donating every year. She's covering from her pocket the overhead of Natal. So all the overhead is being covered directly. So really the donations that go to Natal really go to the organization and the people that need it. And Ned and Rachel was great to join us. And I know Michael, you also joined us recently, and it's really great to have good people trying to help other people. I think that's part of YJP and part of our mission here.
What's the best way to donate if you want to get involved?
The best way is what you're doing right now, even just talking about it. So if you're interested, we're happy to share. I think Rachel, you can share. Rachel,
yes, you could on the chat. If you guys direct message Rachel on the chat, she'll I'm sure loop you in on that information.
The best way to join, Rachel, the best way is to join our next roundtable of young professionals. Right, that's the great way.
That would be great. I'll share my email, so if you're interested, you can just shoot me an email and we'll get you in the loop.
Okay.
So Raquel, I think that brings us to 1:30. I think we were supposed to end by 1:30, so I think we're pretty much on time. So Ron, thank you very, very much. We really appreciate your time and your insight. Raquel, are you gonna shoot around kind of contact information if anyone has follow-up questions or anything like that?
Yep.
Okay, perfect. So thank you guys, and hopefully we'll all stay in touch, and hopefully everyone stays safe and healthy.
Thank you very much.
Thank you, everyone.
Thank you, Ron.
Thank you.
Thank you for organizing this.
Thank you.
Okay, bye.
All right.